Welcome to This Explainer. Have you ever wondered what the ultra-wealthy or massive financial institutions actually do with their cash when they aren't actively investing it? Well, today we're pulling back the curtain to see exactly how sophisticated investors intelligently protect and manage their money. We're going to take some pretty complex financial mechanics and break them down into clear, actionable steps that you can actually use. So imagine you suddenly have $100,000 in cash. Maybe you just sold a house, maybe you got a big payout from a business, or honestly, maybe you've just diligently built up your savings over the years. Now you're sitting on this lump sum, and you might actually be feeling a little paralyzed. You don't want to dump it all into the stock market because, well, the market could completely tank tomorrow. But you definitely don't want it just sitting idle either, because inflation is always out there, slowly eating away at your purchasing power. And you certainly don't want to lock it away in a vault for decades.
All of this leads us to a massive, slightly stressful question. Where do you put the money? It builds a real sense of tension, right? Well, what's really fascinating here is that the smart money around the globe often solves this exact conundrum by turning to one of the absolute simplest instruments in all of global finance.
Section 1. Meet the Treasury Bill.
Let's officially introduce this instrument. The U.S. Treasury Bill, or T-bill for short, is the short-term, low-risk vehicle of choice for institutions and experienced investors everywhere. What is it? A T-bill is simply a U.S. government debt security that matures in 1 year or less. When you buy one, you are essentially just lending your money to the United States government for a relatively short period of time. In exchange, you get capital preservation and liquidity. And because these are backed by the U.S. government's ability to pay its debts, you get incredible safety without having to lock your cash away for 10 years.
Section 2. How T-bills make money.
Now, you're probably asking, how do they actually generate a return? Unlike your standard savings account, T-bills don't usually pay regular monthly interest. Instead, to understand how this works, I want you to anchor your mind to one specific number: $1,000. This represents the face value of a typical Treasury bill. Just keep this number in your head because this is the exact amount of money you'll eventually receive when the bill reaches maturity, basically when your lending time is up.
Here is exactly how this frictionless little cycle works. Step 1. You buy the T-bill for less than its face value. It's sold at a discount. So, for example, you might pay roughly $980 today. Step 2. You just sit back and hold it until maturity. And Step 3. The government pays you that full $1,000 face value. Notice how your return isn't some separate interest check mailed to your house. Your return is generated entirely from the difference between your discounted purchase price and that final maturity value. It is literally that streamlined. Section 3. The T-bill ladder strategy. Okay, so to balance earning a solid return while still maintaining access to cash, the pros use a timeline strategy called a ladder. Imagine you have $40,000 you want to put to work. Instead of dumping all of it into one single T-bill with one maturity date, you chop it up. You buy one batch that matures in 1 month, another in 3 months, and another in 6 months. As each investment matures, a portion of your cash frees up. At these intervals, you've created multiple decision points for yourself. Do I spend this 10 grand? Do I move it to stocks? Or do I reinvest it into a brand new T-bill at whatever the new interest rates are? A ladder prevents you from being locked into a single rate and gives you fantastic, flexible control over your cash flow.
Section 4. Comparing your cash options.
Now, T-bills obviously don't exist in a vacuum. You might be wondering, hey, why not just use a high-yield savings account or CD? Let's break it down side by side. For a savings account, the issuer is a bank, and you get immediate liquidity. That makes savings accounts absolutely the best option for your true drop-everything emergency funds. But look at CDs and T-bills. CDs are also issued by banks, but if you need that money early, bam, you get hit with an early withdrawal penalty. T-bills, which are issued by the government, have totally different rules. If you need the cash early, you don't pay a bank penalty, but you do have to sell it on the secondary market. That means the price you get might fluctuate based on current interest rates. Because of this, T-bills are absolutely perfect for cash you know for sure you won't need for a specific short period of time.
But check this out, because here's an incredible, almost hidden advantage for T-bills: their tax treatment. A standard yield from a savings account or a CD is subject to all taxes: federal, state, and local. The whole shebang. But a T-bill yield, it's generally subject to federal income tax, but it is completely exempt from state and local income taxes. If you live in a state with high income taxes, two identical yields on paper could actually result in vastly different take-home results for you. Smart money never just asks, what's the interest rate? They always ask, what do I actually get to keep after taxes?
Section 5. Understanding the risks.
All right, it's time for a quick reality check. We've got to dispel the myth of zero risk, even when we're dealing with securities backed by the full faith and credit of the U.S. government. Whenever someone tells you an investment is safe, you always need to ask, safe from what? First up, inflation risk. If inflation is running higher than your after-tax return, your actual purchasing power is still shrinking. Second, reinvestment risk. When your T-bill finally matures, future interest rates might be lower than they are right now. Third, opportunity cost. While your cash is sitting safely in government securities, the stock market could go on a massive, record-breaking run, and you miss out on that growth entirely. And fourth, selling early. Like we just talked about, if you sell a T-bill before maturity on the secondary market, its price can and will fluctuate. So remember, low credit risk absolutely does not mean no risk.
Section 6. The Smart Money Framework.
Okay, to pull all of this knowledge together, I want you to guide yourself through a few crucial self-assessment questions. These are the exact questions the smartest investors use before parking their cash anywhere. 1. When will I actually need this money? 2. How quickly must I access it? If your answer is tomorrow, then liquidity matters most and you should stick to a savings account. 3. How much volatility can I stomach? And 4. What is my actual return going to be after taxes and inflation? What you'll quickly realize is that the smartest move isn't always about maximizing your returns at all costs. Sometimes the absolute best financial move you can make is simply finding a productive, safe place to wait for your next big opportunity.
And that brings us to our final and honestly most important thought. What job does your money need to perform? Think about it. Every single dollar you have needs a specific job description. Is it supposed to grow aggressively? Is it your rock-solid safety net? Or is it just waiting on the sidelines, preserving your capital while earning a nice bit of tax-efficient yield? I challenge you to apply this framework to your own wealth and make absolutely sure every dollar is doing exactly what you hired it to do. Thanks for joining me on this explainer. Stay curious and keep learning.